want to talk a little bit about the two main narratives that have emerged to explain why investors lost faith in investment banks, and how journalists wrestled with these two narratives as they sought to cover the financial meltdown. Depending on the narrative you subscribe to, journalists were either fanning the flames of the crisis and making things worse, or were just doing their jobs as the inevitable took shape. But reporters are acutely aware of these two narratives, and they probably had at least some impact on our coverage. Let's start with the narrative that I will call the Burrow hypothesis. I named it for Brian Burrow, who wrote an influential story in Vanity Fair that appeared in early July 2008. Burrow is a former reporter for the Wall Street Journal and a co-author of Barbarians at the Gate. And his stature in my profession is roughly equivalent to the stature of an Eric Foner in yours. He's a sort of dean of the field, widely respected and widely read. Burrow's piece in Vanity Fair was a lengthy post-mortem about the demise of Bear Stearns, the first major investment bank to go down. The first half of the piece talked about Bear's obvious missteps, the lack of senior management oversight of risky businesses, its failure to raise more capital when clouds were gathering on the horizon in the fall of 2007, and so forth. But about midway through the piece, as he nears March 2008, when Bear actually crashed, he pays particular attention to comments made by news reporters on television network CNBC, a network that is watched on trading floors and in executive offices all across Wall Street. In a crucial scene at the center of the piece, a rumor of Bear's imminent demise has hammered the bank's stock price for days. CNBC anchor David Faber is interviewing Bear's chief executive, Alan Schwartz. The first question Faber asks is essentially, are people still willing to trade with you? He cites a trader whose credit department has temporarily refused to trade with Bear Stearns because of concerns about the investment bank's health. Burrow then cuts to Bear Stearns, where many executives are gasping. He quotes a Wall Street trader of 40 years who says, quote, "Once you raise that idea that the firm can't follow through on a trade, it's over. Faber killed him. He just killed him," end quote. So the Burrow hypothesis is this. Bear Stearns made many missteps of its own, but what ultimately killed it were hedge fund investors spreading malicious rumors. Journalists unthinkingly repeated and reported these rumors, adding fuel to the fire. In the end, the negative rumors pushed down Bear's share price to the point where banks and clients would not do business with it, and the company could not raise capital. It had no choice but to sell itself to JP Morgan Chase for a bargain price. Without these rumors, Bear Stearns may have had more time to fix the obvious problems it faced, and might still be around today. This narrative is widely repeated on Wall Street. Many traders believe that after Bear went down, hedge funds targeted Lehman, and then Morgan Stanley and Goldman Sachs. Journalists are enablers, according to this narrative, serving as tools of short sellers. It is, of course, self-serving for bankers to view things this way, because it shifts blame for the meltdown away from executives who made poor business decisions and toward malicious actors looking to profit in the worst possible way. But even some who were implicated by this theory subscribe to it. I had dinner last week with a prominent journalist who made this very argument, and there seems to be some sympathy for it in some quarters of Washington, D.C. The Securities and Exchange Commission is currently investigating short sellers to determine their culpability for the demise of banks like Bear and Lehman. And the SEC, of course, temporarily banned short selling in 2008 in an effort to prevent banks from collapsing. Let's move on to the second narrative, which, for lack of a better name, I'll name after yours truly. We'll call it the Wilchins hypothesis. I hope that people in this room will seize on this name and make it the industry standard term, thus guaranteeing me my rightful place in history. This narrative goes as follows. Banks were woefully undercapitalized heading into this credit meltdown, and their executives were consistently too slow to recognize the extent of their problems. Bear Stearns was the first domino to fall, and it fell shortly after Fed Chairman Bernanke warned that banks were reluctant to write down their mortgages, but probably had to. The only thing that saved the other investment banks was the expectation that the U.S. government would support their bondholders and trading counterparties, as it did for Bear Stearns. After the Bear Stearns sale, that support seemed fairly certain. In the weeks before the Lehman collapse, that support was called into question, and of course after Lehman went under, investors panicked. To prove every element of this argument would take a long time, but let me lay out at least one of the important planks. Going into the credit crunch, most investment banks had borrowed more than $30 for every dollar of actual equity or capital that they had. During the crisis, investment banks struggled to shed problematic assets and raise capital. But even with these efforts, they did not go far enough. The week before Lehman filed for bankruptcy, it reported having about $600 billion of assets, supported by roughly $20 billion of equity. This is a catastrophically stupid way to capitalize your company because it gives you almost no margin of error. In the Lehman example, where the bank had $600 billion of assets and $580 billion of debt, there was essentially just a 3% cushion for shareholders. If the company's assets declined 3%, Lehman was out of business. Even a 1 or 2% decline could very well be problematic. I'm not sure that I've explained clearly enough how worrisome this is, so let me make an analogy. Suppose I offered you the chance to buy a mutual fund and explained that in good times it would return about 15% a year. But if its value ever fell 3% or more, you would lose all of your money. Would you ever invest in such a fund? Would you ever do business with such a fund? That mutual fund was called Lehman Brothers. Bear Stearns and even Goldman and Morgan Stanley were not so different from Lehman. That 3% cushion I mentioned for Lehman was about the size of Morgan Stanley's and Bear's as well. Goldman had a 4% cushion in the fall of 2008, which is a little better, but again, not that heartening in a year where the stock market was down 38% and U.S. corporate bonds fell about 7%. So according to the Wilchins hypothesis, investment banks were houses of straw built on foundations of sand. Blaming rumor mongers is unfair. Investors and customers were making reasonable decisions to avoid taking risks for which they were receiving insufficient rewards. And to the extent short sellers made money along the way, there's nothing illegal with that, unless traders knowingly spread false information in order to kill investment banks, an assertion for which no hard evidence has yet emerged. So given these two narratives, I would now like to talk a little bit about the morning of July 10th, 2008, about Lehman Brothers circulated in the stock market that PIMCO, the largest bond manager in the world, had stopped doing business with the investment bank. Lehman's shares lost as much as 18% of their value as the rumor spread through the market. What was interesting about this rumor was that it emerged just days after Brian Burroughs' piece came out, and I suspect the Vanity Fair story had some impact on journalists reporting in general, and CNBC's reporting in particular. CNBC's David Faber said that Lehman shares were down because of a rumor that he would not even bother repeating, which was odd because usually he has no qualms about repeating rumors. At Reuters, we have a policy of reporting rumors if they are market moving, and we decided that this situation was no different from any other. Our feeling was we must try to track down rumors and get to the bottom of them. But in the meantime, our readers were trading Lehman shares and were wondering why they were moving so much, and they deserved to know what others were saying. We knew we could be accused of hastening the demise of Lehman Brothers, but we decided our job is to report the news and not to worry if the news hurt some people. We spoke to PIMCO and Lehman before putting out the information. PIMCO initially declined to comment. Lehman implored us to refrain from putting out the news altogether. They argued that it was false, it would hurt their business, and that other news outlets were refraining from reporting the news. PIMCO later went on the record to say the rumor was false, and that became the story. Lehman's shares dropped because of a discredited rumor. But in the end, every other publication that day reported exactly what we had, that apparently false rumor pulled down Lehman's shares. And so even though the Burrough hypothesis was in the air on that July morning, it appears to have made some news outlets hesitant to report the story early in the news cycle. By the end of the day, we were all in the same place. I have offered my own hypothesis for why investment banks failed in 2008, but I acknowledge that we may never know exactly what happened. I recognize that my argument could be described as self-serving because it expiates reporters, turning them into scribes chronicling the inevitable instead of accessories to a crime. It is possible that both Burrough and I are right. Perhaps hedge funds provided the spark, that little pile of dry kindling. Perhaps had it not been for hedge fund rumors, some other spark would have ignited the pile. But the point I wish to make is that most reporters knew while they were reporting this story that they could be accused of being complicit with hedge fund managers that were profiting from the demise of investment banks. Some reporters may have behaved more gingerly in some cases. But even so, most media outlets continue to report rumors and generally put out the news as it came. And so the Burrough narrative may prove in 2 years' time to be a fair explanation of what happened, but it was not a compelling enough narrative to save the investment banks in 2008.